in the markets, and we have someone very, very special. So we have Jordan Eliseo. He's the Manager of Listed Products and Investment Research from the Perth Mint. Jordan is a precious metals and market analyst with almost 25 years experience working in financial markets. Jordan was also the chief economist at ABC Bullion, where he was responsible for building the ABC Bullion Gold Saver facility, which was Australia's first fully automated bullion savings plan, as well as publishing the annual Self-Managed Super Fund Trustee Physical Bullion Investment Guide. Jordan has worked with companies including BT Financial Group, Deutsche Bank, JP Morgan, Casanova Capital, AMP Capital, and now he's with the Perth Mint. He's also the author of 2 books, Gold for Australian Investors and Dire Straits, Money for Nothing and Debt for Free. How appropriate. So I'm going to bring Jordan onto our stream. Welcome, Jordan.
Thank you for having me on the show today. Hi, Lan.
Hi, how are you, Jordan?
Yeah, doing very well, thanks. Thanks, everyone, for joining as well. It should be fun.
Yeah, it should be fun. We're so ready to learn. There's so much happening out there that we're trying to keep a tab of what's happening in the economy, and knowing to know what to do next is it's anyone's guess at the moment. But we're hoping that you can shed some light and tell us a bit more about this shiny metal that everyone's talking about at the moment.
Sure, not a problem. I look forward to it. Do you want me to? Oh, sorry, you go, Phil.
Yeah, so I think, Jordan, you've got a whole pack of information that you're going to share with us. Is that right?
Yeah, absolutely.
Fantastic. If you bring that up, I will bring that up on screen. Oops. And here we are. Whoops. So, have you got your you just need to alt tab onto the right one there, Jordan, and we can.
Can you see the presentation now?
Yes, we can.
Great. Okay. All right. So I'll run through this for the next 20 odd minutes on that, and then if there's some questions at the end, be very happy to go through them. It should be great. So as I say, the title of the talk today, I suppose, is the role of gold in a diversified portfolio. So mostly want to talk through the various attributes of gold as an investment, the way it sort of interacts with equity markets, interest rates, and also talk a little bit about how you can buy gold as well. Philip obviously mentioned that everything is just general information, not advice in any way. But if I just sort of go through the areas that I'll cover specifically, or I suppose the order of what I'll run through, I'll actually start a little bit with the kind of how. So, what are the different ways you can own gold in a portfolio, and what are some of the costs? I'll then look at the benefits. So, the reasons you put it in your portfolio. Talk a little bit about the demand trends. Obviously, at the Perth Mint, we're at front and centre of the gold market. We refine the vast majority of Australia's gold, which is, for those that don't know, Australia is typically the second or third largest gold miner in the world. Produces over 300 tons of gold a year, so it's a precious metal that's actually incredibly important to the Australian economy. And obviously, we then not only refine it, but then sell it to investors in multiple forms. So we're sort of got a front row seat in terms of being able to monitor gold demand. I'll then talk a little bit about gold and its interaction with inflation, deflation. That's a subject that we get asked a lot about at the Perth Mint, so that might be of interest. And then I'll finish by actually talking about the outlook for gold now, but also sort of contextualise that given what's happening with COVID-19 and how that compares to the global financial crisis just over a decade ago.
Fantastic.
So if we get started, the kind of how and what does it cost to actually invest in bullion? So there are 3 primary ways that you can invest in gold, and I've titled this like through an SMSF because I guess some people will have that, but in reality they're they're three ways that are relevant for all investors, not just for people that have a self-managed super fund. So the first one is that you can buy physical bars and coins. The second one is you can use what's called a depository account. So think of it as being like a stockbroking account, but rather than buying shares, you're actually buying precious metals. Or, of course, you can invest in a gold ETF, which actually can be bought via your brokerage account because it's essentially a security or a financial asset that trades on the stock exchange and tracks the price of gold up and down. Now, there's no right or wrong way. It very much is a personal decision. But I've listed some of the sort of positives and negatives of each approach. So the first one, the most obvious positive to buying physical bars and coins is that you obviously are going to have clear legal title to those physical items. And given you can store gold in a private vault or at home, you can actually store gold with a very minimal storage cost. The negative, though, is that it's typically more expensive to buy gold in that form. So if you're buying lots of small bars, you'll be paying over 2% as a premium. If you're buying lots of small coins, you'd be paying even more. It's also less liquid because obviously if you've got it in your home, it's not as easy to get it back to a bullion dealer or an exchange or a broker to sell it to. And this last point is relevant to people that have SMSFs, is that it's harder to do valuations and audit if you're storing it at home. Not impossible, but very different to just being able to get a statement from a third party saying, you own 10 ounces of gold and here's the value of it. So that's where option 2 comes in. So a depository account. The positives of that are that it's typically lower cost than buying bars. All of your storage, your valuations, your audit are included and are incredibly simple to do. And you can typically trade 24/7, which is attractive to some investors. The negatives, if I can call them that, is that it's a separate account process and a bit harder to manage at a portfolio level. So, if you're used to doing everything via your broking account, then obviously, you need to move money separately to a bullion dealer. So it's just a little bit more work involved from that perspective, which then leads us to option 3, which is increasingly popular with investors these days, which is to just use a gold ETF, and Perth Mint's got one on the ASX. The ticker code is PMGOLD, which is very popular with investors, and it makes sense why it is. It's incredibly cost efficient. It's also able to be bought and sold like regular shares, and obviously given it's a security or a financial asset that's trading on an exchange, your valuations and your audit and the like are very simple. There are some negatives to gold ETFs, or perhaps less than ideal qualities. Not all ETFs, but as a general rule, there's typically a lot of counterparties involved. You don't always have legal title to the gold, and you can't always take delivery in gold. I'm glad to say that the Perth Mint's that last point doesn't apply to them, and any investor that uses our ETFs can actually convert their holdings into physical items if they so choose. But to give you guys a sense of cost, because this is always important, I think, in terms of what does it actually cost you to buy, sell, and store any particular asset. This next slide's got a couple of tables which I think should be pretty interesting. So the first one shows the average management fee for all ETFs on the ASX, broken down by asset class. So if you look at the market there, you can see that currency ETFs are typically the most expensive, followed by infrastructure and commodities. Fixed income is the cheapest. Gold is the second cheapest. And I've just taken an average, as I say, of all the products that can be categorized in these various asset classes. And when you look at the trading fee, you can see that gold is by far the cheapest. You can trade gold at an average of sort of 10 to 12 basis points. Compare that to currency, fixed income, commodities at the other end. You can see that gold is actually a very efficient asset to buy, to sell, and to store. And that's great news for an investor, because it basically means you get to keep more of the return for yourself. So that's a little bit on the practicalities of how you can buy gold. But let's talk a little bit about why. What are the main reasons you would hold gold in a portfolio? And the first one is actually that over the long run, gold has delivered very strong long-term returns. So the chart that you're looking at there shows the returns from basically the turn of the century through to the end of June this year. And I've shown the price of gold in both Australian and US dollar terms. And you can see that irrespective of which currency we're looking at, you got returns of around 500% cumulative and nearly 9.5 to 10% annualized, which is much stronger than most assets have done over this time period. And whilst gold hasn't always done as well as it has the last 20 years, actually, if you go all the way back to the start of the 1970s, and obviously before that, gold and money were formally linked, the price of gold has risen by about 8% per annum. So very, very solid capital gains. The next point that's I think really relevant for investors to be aware of is just how effective a hedge against volatile equity markets gold is. So the chart that you guys are looking at there shows the 5 worst calendar years for equities. Those are the red columns. You can see the worst was 2008 when the market dropped 40%. And you can also see the returns on gold in those 5 years. And with the exception of 1990, where the gold price was flat, you can see that the average return for gold was very good. You got returns of 28%, 29%, 49, 87. The performance differential between gold and equities in these years comes to about plus 40% in gold's favor. And importantly, gold also outperforms both bonds and cash, which are kind of the traditional safe havens, in those periods as well. Now, obviously, this chart looks at the worst 5 calendar years, but even if you were just to take the average year where the equity market declines, or the average month, or the average quarter, you'll find that gold has typically delivered positive returns, and indeed returns that have beaten other asset classes. So it's a pretty effective hedge, or at least historically has been, for when things go wrong in equity markets or in other asset classes. On top of that, gold also tends to do incredibly well when real interest rates, which factor in inflation, are low. And obviously, Philip mentioned before, rates are at 0.25% in Australia now. So the chart that you're looking at now shows the average nominal return and the average real return, i.e. inflation adjusted, for stocks, for bonds, and for gold, all in Australian dollars, in the years between 1971 and 2019, where real interest rates were 2% or lower. And as the slide's telling you, over that time period, that near 50-year time period, there were 22 years when real rates were 2% or lower. And you can see that on average, gold rose by about 20% per annum in those years. And you can also see that it outperforms stocks and bonds. And this is one of the reasons why we're seeing so much demand for gold now amongst our clients, because people are saying, well, you know what, I'm getting paid less than zero in real terms if I leave my money in the bank or in a term deposit. So, I'm not going to take all my money out of the bank, but I want to move some of my capital into an asset that tends to thrive in periods of low real rate or in periods where rates are low. And the data is pretty clear that gold has tended to be an outperformer in environments like this. A couple of other points, that are important. They don't necessarily feed into the performance of gold, but they're nonetheless important attributes of it as an investment. And that is that, gold is incredibly simple. Anyone can buy an ounce of gold and put it in their portfolio. The market is also incredibly large. The total gold stock is valued at more than $10 trillion today, which would make it the second largest sovereign bond market in the world. And the outcome of it being such a large market is that it's so liquid. With more than $150 billion a day in daily turnover. That's like 25 times the turnover you see on the ASX. So that feeds into why gold is such a low-cost asset to buy and sell, because it's such a large market in terms of daily turnover. And as I highlighted earlier, gold can be a low-cost investment as well. So let's move on from there and talk about demand and what we're seeing there. So the first thing to point out is that we're seeing really incredible central bank gold demand over the last 10 years. And the chart that you're seeing here shows annual net buying by central banks from 2010 onwards. And you can see that they've been buyers every single year. That is a massive change from what was occurring in the lead up to the global financial crisis. Central banks had been net sellers for basically 20 years, but for the last decade, they've totally changed their tune. And the important thing to note is that developing market central banks, so your Brazils, your Russias, your Indias, your Chinas, they still have substantially lower gold reserves than most developed market counterparts. So they're very likely to be net buyers of gold for years to come, and that helps support the gold market. The next one, though, is what we're seeing and this is probably the real story of the year, is what we're seeing with gold ETFs. So the chart that you're looking at there shows annual inflows into gold ETFs from 2004 to 2020, with the 2020 data obviously going to just the middle of May, actually, when I ran this. And you can see that this year we've seen over 700 tons go into gold ETFs, which is more than any full calendar year before it, including 2009 when the GFC hit and when QE1 started, and indeed 2016 when Brexit occurred and when Trump won the presidential election. Now, the interesting thing to note is that whilst ETF inflows are running at the pace they are, gold ETFs as a percentage of the total ETF market in the US are still only around 2% of the total. Back in 2011, 2012, they were closer to 8%. So some people look at this chart and go, oh God, there's been a lot of buying. Is that a problem for the market? The reality is we're still a long way from seeing, what I'd call major froth in the gold market as a whole. So that's a very interesting stat. And indeed, so I'll just talk about that one more point. Here in Australia with PM Gold, our product, we've seen holdings rise by over 70% for the year, which just goes to show you how much demand there is for gold at the present time. So let's move on a little bit and talk about inflation or deflation and whether or not that matters for gold. And the reason I bring that up is because a lot of people see gold as just being a hedge against rising inflation. And given inflation is pretty low right now, they sort of say, well, therefore I don't need to own gold. But the reality is far more nuanced than that. And this chart will help explain it. What it shows is the gold price, that's the gold line from 1970 all the way through to 2020, June of this year. And the blue line shows the rolling annual changes in consumer price inflation over that same time period. And then the red line shows the average inflation rate across the three major cycles we've seen in gold, which is basically 1970 to 1980, 1980 to 2000, and 2000 to 2020. And what you can see is in the 70s, yes, we saw high inflation, and yes, we saw very strong gold price performance. And that's why people think, oh yeah, gold is just a hedge against high inflation. If you look from 1980 to 2000, gold was actually in a bit of a bear market, even though inflation was still averaging more than 4% per annum. So it was comfortably above, what central banks would typically target. In the last 20 years, though, inflation's only averaged about 2% per annum, yet the price of gold's gone up by nearly 10% per annum and outperformed everything else. So it's very, very clear that whilst inflation is a factor that can drive gold, it is not the only factor. Gold can still thrive in an environment of low inflation. And the reason for that is that the more important metric is probably real yields, i.e., what can an investor earn keeping their money in a US Treasury bond, as an example, or another kind of government bond. And the chart that you're looking at there shows the gold price from 2003 through to now, as well as the real yield on a US 10-year Treasury. However, I've inverted the real yield. So as you see that red line going up, what it basically means is the real yield is going down. And you can see the correlation there. As real yields decline, gold prices tend to do better. And that makes sense because it very simply reflects the fact there's less opportunity cost in investing in gold. Now, the key thing to keep in mind, and I've got a little table here in this slide that you can see, key thing to keep in mind is that even if you look at 30-year government bonds now, they are offering a negative real yield. So if you're to park your money in them, you are guaranteed to lose money every year between now and 2050. Now, obviously, investors aren't particularly comfortable or happy with that, and that's part of the reason why we're seeing further inflow into gold. Before I finish up and turn over to questions, I just want to finish by talking about the outlook for gold and contextualize that given COVID-19 and comparisons to the GFC. So let's talk about some of the similarities and the differences. So the similarities are that gold was actually performing very well leading into both crises, and then it saw a bit of a pullback as investors sought liquidity. The demand for gold was strong leading into the GFC, very strong leading into COVID as well. And also, if we look at other markets, equities were very strong leading into the GFC, and they were also very strong leading into COVID-19. 2019 was one of the best years ever for the equity market. But today, you've got markets priced at similar valuations in the United States, similar valuations to where they were in the GFC before the market crashed. In terms of the differences, and this, ultimately is why I'm even more optimistic on the outlook for gold in the years ahead. Obviously, you've got a public health threat, which complicates the path forward this time around that simply wasn't there when the GFC hit. We've also got the fact that debt levels are much higher now. So government debt to GDP ratios across the developed world are about 40% higher than what they were when the last crisis hit. And on top of that, you've got the fact that yields are much lower. So, again, if we look at the US 10-year as an example, it averaged 4% across 2007 and 2008. When I ran the numbers for this presentation, it was, below 0.7%. And finally, you've got inflation risks are more apparent this time around, both because monetary and fiscal policy are so much more expansive and because you've got supply chain challenges as a result of COVID-19 that, again, weren't there when the global financial crisis hit. There's arguably one other factor that is an even bigger difference than all those others and that I really think helps set the stage for, potential gold outperformance in the years to come. And that is very simply the relative value or relative price between financial assets and commodities. And the chart that you're looking at now very simply measures the S&P Goldman Sachs Commodity Index to the S&P 500 ratio. Anyone could create this chart just by downloading some data off of, from Google, right? And we're basically measuring one divided by the other. And very, very simply, as that ratio goes up, it means that financial assets are underperforming commodities, or should I say, commodities are getting more expensive relative to financial assets. However, when the chart is falling, it means financial assets are outperforming commodities. And, I've highlighted on the chart the three great crises of the last 20 years. So when the dot-com bubble hit, commodities were very cheap relative to shares. By the time the GFC hit though, commodities had never been more expensive relative to shares. And over the last 12 years, shares have outperformed very, very substantially, such that by the time COVID-19 had hit, commodities had never been cheaper relative to financial assets. So if you in any way believe in mean reversion and that markets tend to, move in cycles, it should not surprise in any way if over the next 10 years, commodities tend to outperform. And so if I can summarize the talk today, I think the key takeaways are that, gold has performed very well as economic uncertainty and market volatility is increasing. The demand for the metal is very strong, especially seen through, central bank and ETF demand. High inflation, yep, it would help. It would be an additional tailwind for gold, but low inflation's no threat to strong performance from precious metals. And two final points, the long-term picture is positive. Due to low real interest rates, the risk factors in the economy and expensive financial markets. And really the threat from COVID-19 only reinforces those factors. And lastly, gold is a very low cost, simple investment that can play a positive role in a well-balanced portfolio. So thanks very much for your time, guys. And I think it's probably a good time to turn to questions.
Fantastic. Thank you so much, Jordan. That is an incredible data set there that you've presented to us. Now, you've spent, the last 25 years in the financial markets and specializing in precious metals. So how's that journey been for you?
I have. So actually one of the things that might be of interest to people is that I, at the risk of oversimplifying it, I'm not a gold bull because I work in gold. I work in gold because I'm a gold bull, if that makes sense. So I actually spent the first sort of 15 years of my career working in sort of conventional asset management, portfolio construction, and the like. But with a lot of my own money and family money, I actually had it in gold from really the early 2000s because I sort of figured it was, a good chance of having a bull market run. And then, several years ago, I was like, look, I've obviously got a passion for gold and a bit of a background in financial markets. And that's why I moved over to actually working in the gold industry. By and large, it's been fantastic. I actually loved working in for large super funds and large asset managers. But I love working in precious metals. It's really it's an exciting story to tell the precious metals story, and it's actually, the risk of sounding a bit silly, but it's actually really cool working with gold. It's this physical, beautiful item it's great. And when people hold it in their hand, there's a sense, people just get that it's valuable, right? So I love working in precious metals.
Fantastic.
Sure.
We've got a few questions that are coming through, Jordan. Hope you can help us with some of those. One is, in terms of the gold spot price, can you enlighten us a bit on how
sure.
that is set?
So look, the large bullion banks essentially trade gold with each other over the counter for a substantial period of time throughout the day. And then there's also a very active gold futures market. COMEX is the largest market by far, which also has billions and billions of dollars worth of trade going through. So I mentioned during the presentation, there's roughly $150 billion a day of daily liquidity in the gold market. Without knowing the exact numbers off the top of my head, I could bring them up, but I would say maybe 50 to 60% of that is OTC, so bullion banks trading with each other. 38% of it is the futures market, and then a small amount of it is ETFs, and then also what I'd almost call like retail trade, where, so like if a client is buying directly from us, that's OTC essentially, right? Then twice a day, what still happens, they used to call it the London Gold Fix in the old days. It's now called the LBMA gold price. That's where essentially the global gold industry gets together. There's around 15 banks involved in the process, and there's essentially an auction via which a reference price for gold is set twice a day. And those numbers are publicly available. So people can easily go and, download decades worth of gold price history to sort of be able to see how the markets performed and the trends in the market. So it's a highly liquid market, and that's essentially how prices are determined.
Fantastic.
Can I ask a question?
Please do.
So you mentioned cycles in asset prices. So is gold in a bull market at the moment? Obviously, and why? What are some of the factors that will drive prices in the direction it will go in the next, I guess, 3 to 5 years?
Sure. Look, I think anyone looking at a chart of gold would say it is in a bull market now. So, last year, I think the price of gold hit all-time highs in about 60 or 70 different currencies, including the Australian dollar. This year, the price of gold also hit an all-time high in US dollars. It traded above $2,000 in August. It's pulled back a little bit now. But even if we use US dollars, which is kind of the market most people pay attention to, the gold price was around $1,050 an ounce at the end of 2015. So it's almost doubled over the last 5 years. So it's pretty clear it's in a bull market. What will drive it going forward? Potentially both higher and lower. In my view, the probability is that prices remain biased to the upside for some time to come. But there are a handful of key drivers. One is the performance of the equity market. So whenever there's volatility in equity markets, gold tends to do well. If we see a continued raging bull market in equities, though, you could see gold struggle a bit. The other factor is the US dollar. Gold almost always does well when the US dollar declines. So if we see continued declines in the dollar, gold would be expected to benefit from that. There's also then that, like I talked about in the presentation, there's the real yield story. So as long as real yields stay low, expect gold to find some level of support. And that real yield environment is impacted not just by nominal interest rates, but also by inflation. So even if interest rates don't get cut any lower, every incremental, increase in inflation effectively decreases real yields and makes gold more attractive. And then the last one is just the kind of the portfolio element. So, it's hard to pin this number down because it depends how you calculate it. But the best estimates are that right now, investors only own maybe 0.5 to 1% of their portfolio assets in gold, right? Think of gold as an asset class the supply is incredibly stable, which means the price only moves because of demand, right? If more people want it, the price goes up. If less people want it, the price goes down. So if you think about, if you think of the pool of wealth that investors have and assume that it's $100, only $1 of it is currently in gold. So there is substantially more opportunity for money to go into gold than there is opportunity for money to go out of gold, if that makes sense, because it's currently such a small portion of people's wealth. So yeah, all of those factors are worth keeping an eye on because they'll all have an impact on gold.
Yes. And we've been educating our viewers about debasement and the monetary expansion. So they're quite, they're quite familiar with what's the, I guess, the trend leading forward that influence what you're saying, Jordan. Price of gold more likely to trend upwards than anything in the next short term, medium to long term. Yeah.
Yeah, and I think central banks have been pretty honest about it in the sense that, and not just central banks, policymakers as a whole are acknowledging the problems and the challenges that the global economy faces, and that negative real rates are kind of going to be with us for some time. And you can argue the pros and cons of that from an economic perspective, but from an investment perspective, it hurts if you've got your money in cash or government bonds.
Absolutely.
Yeah, there's really no argument from that perspective.
I was comparing the term deposit rates, like they're giving you like less than 0.25% for holding your money. And in the future, they'll probably charge you for holding your money in the term deposit. So they want to encourage you to take out the money from the bank and do something with it.
Yeah, indeed.
Of course.
So Jordan, I just got another question is, do you know the percentage of portfolios out there, the typical Australian, like what's the percentage of people that actually hold gold in their portfolio?
Yeah, so look, I would say that the best estimates are that at most 2%, but it's probably more like 1 to 1.5% of investors actually own gold bars, coins, or a gold ETF in their portfolio. Now, having said that, that 1 to 2% of investors wouldn't just have 1 to 2% of their portfolio, right? They've probably got 10 or 20 or in some cases more. But that's why you end up with kind of like a total portfolio balances of definitely less than 1%. Because if you've only got, if you've only got 1 to 2% of people that own it, and then even if they own 20 or 30% of their money in gold, it's very, very small as a share of the total pool of wealth. So if you look in Australia, this is one way of proxying it. There's roughly $3 trillion in superannuation. There's only $2.5 billion in the gold ETFs, for example, in Australia. If you think, so 10% of that, 10% of the super pool is 300 billion, 1% is 30 billion. So less than 0.1%, if you were to use it that way, is in gold now.
Oh.
Time for Australia to catch up.
But yes, like compared to other countries, like America, let us say, they're much more into the precious metals, a part of their portfolios. Is that correct?
Yeah, that's very true. I think it's it kind of makes sense though why Australia is sort of behind the curve, for want of a better term, in terms of gold in a portfolio. So I think probably three key reasons for that. One, we're only now just having a recession for the first time in 30 years, whereas, the GFC really rocked, the Northern Hemisphere developed economies. We're really also only a year now into negative real interest rates in Australia, whereas, again, that's been part of the landscape in Europe, North America for over a decade. And thirdly, if you think of Australians, the love affair has typically been with property and for some very good reasons. And really up until the last 18 months, unless you were in Perth or, say some mining towns and the like, property's been rock solid up until really, a couple of years ago. So whilst rates have been lower, there's been less of a need to turn to something like gold, I think, in Australia. But, all of those things have changed now.
Agreed. Especially the third one.
Yeah.
So just to touch on a little bit about, really interested to hear about the ETF and Perth Mint's ETF, that you can actually get the physical bullion if you wanted to. Like most ETFs, there's been, I don't know, conspiracy theories maybe about the influx of ETFs, but not having the physical gold to support that. What's your view on that?
Yeah, look, obviously, I don't really want to sort of talk down the competition, as it were. I'd rather focus on how we do it. But yeah, look, the advantage of dealing with the Perth Mint, there's a few in terms of using our ETF. Firstly, the fact that it is physically redeemable. So every month we have 2 or 3 clients. You just fill in what's called an exercise form, where you convert your holding, and every 100 units of it you own entitles you to 1 ounce of gold that we will hand to you in a physical bar. Obviously, if you own 200 units, you could take a 2 ounce bar if you wanted to, as an example. Most ETFs don't offer that ability for an investor to do that in Australia. The second thing that's attractive to investors in our ETF is it's very cheap. So, I spoke during the presentation that gold ETFs as an aggregate are cheap. Ours is by far the cheapest on the market. It's less than half the price of its competitors. And then I think the third thing, obviously, we're owned by the Western Australian government. It's our sole shareholder. And as part of that, the Western Australian government, we have a government guarantee that effectively underpins all of the liabilities that we have to our investors. So, I suppose even in an extremist event where something happened to us as an operating entity, investors have got that extra level of comfort in terms of, that government guarantee. So those 3 factors are kind of why a lot of investors are sort of turning to our product now. They get the gold price exposure just as simply as buying shares. But if they ever decide, I actually really want to hold on to it, they can just fill in a form and take the metal.
Fantastic. Now, you've got other products as well, like your Gold Pass. For someone getting started, is that an easy way, or is it? What do you recommend for the absolute beginner? Yeah,
look. Again, it comes down to who the investor is and what they're. So, like, I've got a Gold Pass account that I've just got like $100 savings on it here and there, kind of thing. If it was for the broader, like my investment portfolio, my SMSF, I'd just use the ETF, for example. So it really depends, and also, again, if someone's watching this, if they've already got a stockbroking account, well, they can buy the ETF. They could do it right now, right? If they don't have a stockbroking account, and so like they're kind of more newer to investing as a whole, well then, maybe using something like Gold Pass makes sense. We've got direct depository accounts as well where they can buy and sell gold, silver, platinum. Those things are attractive as well. Again, there's no right or wrong way. It's just it just depends what investors are comfortable doing. I think the beauty of Gold Pass is that it's particularly attractive for investors starting off with smaller amounts, because you can do $50 at a time. If you want. So if you're just trying to sort of dip your toe into the gold market, then it's a really accessible product.
Fantastic. Wow. So much information. That's so valuable. I must thank you again, Jordan. Lan, do you have any questions for Jordan?
I can, because I'm in the financial planning and accounting space, so I can see that a lot of my clients are seeking alternatives from the industry fund and the share market. And they're starting asking about gold and silver as well. So I was wondering if you could. We have a graph about gold and silver ratio coming that we have, and we want to ask you. So, is that something you can comment on? Because I guess Perth Mint has silver as well, right? Although you haven't covered that today. It's going down. Is that something that, if Phil, you might want to bring it up so that. Yeah, so we were just discussing it this morning together. That normally, what can you comment about this ratio? Is it something that is going to go down further, or what's your call?
Yeah, so just on the off chance not everyone watching this knows what the gold silver ratio just very, very simply measures how many ounces of silver you need to buy the ounce of gold, and it's a great way of measuring where both assets are, essentially. In terms of is it going to go down further, look, I think it might. It's just my personal view. I think in the really short term, it's going to bounce around a bit, because you can see, I'm looking at the chart as well now. You can see that it had this quite crazy spike to over 100 to 1 back in March, but now it's already fallen all the way back down towards 70 to 1, which is over the last 20 years, that's actually been about the average. Now, there are periods, and I can see you've marked it on the chart, it looks like around 2011 there, where the ratio drops all the way down to like the 30s, which means silver really outperforms. So if we were to take a 5-week or even 5-month view, I don't have a really strong conviction about where this ratio will go. I'd be just as unsurprised if it went up as well as went down. If we were to take a sort of 5-year view though, and assuming that we stay in a precious metals bull market, then the sort of natural inclination would be to think that the ratio will sort of come down a little bit. And so therefore that effectively means silver's outperforming. I think the thing, and this is just a personal thing, and just in the interest of disclosure, of my precious metal holdings, I've probably got 60% in gold and 40% in silver, so I own both. I think the thing is, from a asset allocation perspective, though, and a portfolio perspective, whilst clearly there are environments where silver can outperform, it's often gold gold is the one that does well when the stock market sells off. Gold is the one that's sort of cheaper to trade. Gold is more liquid. So a lot of investors that are new to precious metals, they tend to want to start with gold for actually very good reasons. So I'm just as supportive of silver. But we spend most of our time talking about gold to investors just because, go back to that earlier point, like 98, 99% of people don't own any precious metals yet. So as a starting point, it's almost like if you're starting to talk about shares with people, you probably talk about blue chips before you go into, speckies kind of thing, if that makes sense. That's kind of my view.
Thank you that's something that is very interesting. So obviously those are more into gold and then silver, because silver I see is more volatile and probably will be more speculative for those who want to try to trade. And for gold, or for preserving wealth and longer.
Exactly.
That's all from me, Phil. So thank
fantastic. So thank you so much for those questions and answers, Jordan. If people wanted to know more, what's the best place to go or reach out to Perth Mint or your?
Obviously Perth Mint's got a website. I've got a Twitter handle as well, which is @Jordan Eliseo if people use Twitter. I'm also happy if you want to share my email with this group. I'm happy to take questions from people. It's pretty easy to remember. It's just jordan.eliseo@perthmint.com. But as I say, Philip and Lan, if you want to email it to around, that's fine. So I'm relatively easy to find. Perth Mint's easy to find. We're happy to answer any questions people have got. For people that have an SMSF, we publish an annual publication now on the role of gold as a strategic asset for SMSF trustees. If you were to Google like Perth Mint SMSF, you'd find that within about 10 seconds. So there's plenty of info out there.
Fantastic. Wow. A lot to take in, and I'd love for people to absorb. But such great analysis there, Jordan. Thank you again. We'll drop your details into the chat afterwards. But I guess for now, it's just thank you so much for joining us on the show.
My pleasure. Thank you very much for having me.
Thank you, Jordan.
Cheers. Bye-bye.
Bye. Okay. Thank you so much. Wow. That was such incredible information, wasn't it, Lan?
Yes. And I'm, I'm been trading for a while, so I was trying to get some of my questions in with the opinion of an expert. So I hope you guys enjoyed that segment. And now this is the segment that we want to make sure that you are investing and gold correctly, the strategy. So we call it the GPS to investing. The gold standing for your goal, your plan, and your strategy. So stay tuned. So the next 15 minutes, 10 to 15 minutes, I'm going to cover if you're a newbie or you're looking to start to buy gold, or even if you're an established gold investor, then you should have the next few things in mind. So GPS, we call it. And let's have a look at so goal is what you're looking for to achieve. So what is your end game and exit strategy? Because a lot of when people invest, as a financial planner, I will ask them, what are you trying to achieve when you invest in gold or invest in that property or invest in that portfolio? So you need to know and have clarity in your goal. And the next thing is to set a plan, the steps you need to take in order to achieve that goal. Okay. So, but the one I want to focus on today is the strategy and the tax side of buying and selling gold in the future. So let's go to that. So as I quickly mentioned, today is general advice because everyone has a specific definition of what their goal looks like, what their risk profile, and what type of investor you are. So the first point is, if your risk profile or your investment time frame is, say, if you're 10 years to retirement compared to, say, Phil and myself have 20 years to retirement, then obviously your risk profile and the type of risk that you're willing to take is different. So we assess and help you with that. Are you seeking to hedge against inflation and the COVID uncertainty? Are you searching for income and capital growth or capital growth? So, if you're looking at gold doesn't generate income as such. Generally, it's more for capital growth and hedging against the inflation, as Jordan mentioned before. So if you're more hedging against the inflation and capital growth, then we look at the long-term strategy. If you're a trader in the gold, you should look at ETFs instead of, or if you're an investor. So depending on which one you decide to do, then we determine the strategy for you. So all of these questions need to be asked before we determine what strategy that we will help you plan your gold investment. So once you determine those answers, then let's have a look at the implications. There are two main things that you need to look at when you're buying gold. The two, which are GST implications, and you can see on our slide that the main thing is that GST is generally looked at depending on what the gold that you buy. So if you buy gold Perth Mint, that's fine, because gold must be 99.5% pure or greater. So no GST is if one of these apply. So silver must be 99.9% pure, and platinum must be 99% pure. So what that means is that if you buy the pure one at the stamp Perth Mint, then there should be no GST. Okay, so that's generally general advice only. Obviously, if you buy other things from other bullion dealers or other private places like eBay, then just double check on that one. Now I'm going to talk about next, which is the more important, is the capital gains. I like to keep things simple when it comes to tax, because obviously the simpler the better to take in. So I've drawn a matrix on the CGT on gold for personal use. So there are some people newbies who like to just own gold for collectibles. So what does it mean by collectibles? So the definition of a collectible can include gold and silver coins. And we have on the left side here, paintings, sculptures, and also coins or medallions and jewelry. So gold jewelry as well. So if your collectibles is up to $500, then there's no CGT. So, if you buy for your own personal, now for personal use as well, up to $10,000. So if you're just buying for the pure enjoyment of coins and gold coins and jewelry, then there's no CGT on the sale. Now CGT is the capital gain or capital profit on when you buy the gold, and then when you sell, the profit is the capital gains. Capital gains or CGT comes in when you buy exceeding up to, more than 10,000 of enjoyment. Then you have to look at capital gains tax, and I would have a tax. I would encourage you to, before you buy the gold, to look at the name or the structure that you're going to buy in, and also if you are an investor or a trader. So the definition and difference between an investor is someone that holds the investment for a longer term, And a trader is someone that buys in and out more regularly. So it could be daily or a couple of hours. So depending on that, then your tax implication will change as well. So for example, we're more focusing on, so if you're an investor, so more like holding it for longer term for preservation of wealth, or investing for the 3 to a year and more, then capital gains will apply. Whereas if you're a trader, then you'll be on revenue accounts. So that means, so if you're buying, you treat gold as a trading stock instead of capital gains. Okay, so most people though don't trade gold because it's not unless you're trading ETFs. Most people will hold gold for the longer term, whether it be 1 to 10 years, or even past 2 generations. So I'm going to cover what are some of the ways you can hold gold. Okay, so the next slide will some of the ways that you can hold gold and the different impacts that it will have on your portfolio and investment. Now we're focusing on tax at the moment. So if you were a newbie and you hold some gold in your personal name, how much tax can one expect to pay? So if you, aside from exceeding the not treating as exceeding the $10,000, so not a personal asset or not a collectible, and you've made, let's say you made $20,000 in the sale of the gold, then you potentially can look at paying tax up to 47%, because that gold capital gain is added on top of your salary and what other sources of income you have. Okay, so if you hold under your personal name, you can look, it's probably not the best way to invest in gold or any investment. You should rather look at getting advice from your accountant or financial planner, if you could structure in a trust or a self-managed super fund, which Jordan has mentioned before. So self-managed super fund, it does allow you to invest in gold, whether it be coins or bullion or ETFs. And you can see that the tax rates within a trust and an SMSF is much more advantage for you. So you can, obviously a trust, family trust, you can pay up to 0%, up to 47%, depending on the way you're structured. SMSF, depending on when you sell the gold. So if you are, and how long you hold it. So we put 0% to 15%, because if you're under the retirement age, then of course you still have to pay some tax, which is generally between 15 to 10%. And if it's after retirement, then you can pay 0%. So SMSF is actually one of the most tax effective way to invest, whether it be in gold or silver or other investments. So please make sure that you review your strategy, your end game, before you go and purchase that gold. The second thing is, can I distribute earnings or profits? So obviously, if you do make money in investing in gold, then you want to make sure that you minimize that tax. So in personal names, if you're holding your personal names, then you have to personally pay the tax in your marginal tax rate. In a trust, you can distribute it to your beneficiaries, and therefore you can minimize your tax to the lowest marginal tax rate of a beneficiary. And finally, if you want to protect your asset, which means, and if you run a business and you don't want to your creditors or get sued and lose your gold investment, then you can see under personal names, there's no protection in your assets. In the trust and the SMSF, there is. Okay, so this simple matrix, and I want to cover also, in a trust, you can also distribute to a bucket company, which caps your income, to 30%. So you can see that there is a lot of alternatives of how you can invest your gold to make sure that you're not paying, half of it and donating it to the tax office. And this is legally minimizing tax. So this is a decision that you need to, and a chat that you need to sit down with your accountant and make sure you're clear on your strategy before you go ahead and actually purchase that yellow metal. Okay. And I think that is the main thing I want to cover following Jordan's presentation. So if you find that you're ready to purchase gold, or you're ready to upsize your portfolio in gold or silver, then I recommend that you do have do have a real set your GPS, so your goal, your plan, and your strategy to make sure that you've got it all under control, and that you're not paying so much tax when you actually make the money in profits. Thank you for listening, and I'll go to questions and any questions.
So is the process, Lan, have you found, to help someone with zero gold to get into gold? Is that process difficult? Is it, does it take a long time, or anything like
that? No, it's not difficult at all, because as you can see, Jordan has covered like how to buy gold. And a lot of people who come to us initially is it's the strategy. So we find that a lot of people are starting to look at in their super. So given that the COVID has since March has had a major correction of about 30% plus in the super funds, in industry super. So a lot of people are losing the confidence in their own super funds. 30% drop in a matter of days is not a good, not ever a good thing. So as you can see, gold annualized is, rather than having cash, because cash also is a devaluation of over time, as well as we spoke about in our past episodes. So gold in your portfolio could hedge against volatility in the share market, which unfortunately is what most of our industry funds are investing in. And secondly, it can hedge against devaluation of your currency, which is our Australian dollar, when the government steps in and expands the monetary policy. And also, I think Jordan also mentioned the interest rate now is almost negligent, so 0.25%. And so therefore, there's no cost in investing in gold anyway. So would you hold your money in cash, in savings, where you get a 0.25% return, or would you look at alternative investments, in gold and commodities, where you could analyze 9% over in the long term? So to answer your question in a long way, no, the process is not difficult. It's just deciding and helping our client how to invest, which structure to invest it in, whether it be in your super fund, in a self-managed super fund, so you can actually roll over your super and into a platform that has gold as an investment. So it's not difficult at all.
Fantastic. So we've got a question here from James. Is there cost to move your current portfolio into a trust structure apart from the trust formation?
Thank you, James. So it depends on where your gold portfolio is currently held. So in terms of the capital gain cost, the tax implications, you mean, James? So I imagine that you have to look at because if you bought the gold as an investment, remember I covered if your gold is under 10,000 and if you treat it as personal use asset, then there should be no capital gains. But if you had it in your personal names, I'm assuming your personal name, James, and the portfolio is more than 10,000, is not treated as personal use asset or collectibles, then potentially we have to look at capital gains, and the cost would be the tax implication. Yeah. So that's one factor, and so it depends on where it's held. But I would say there will be tax implications involved if it was more than a $10,000 valuation. Does that help you, James?
So, for example, if someone did have a self-managed super fund, is there a large cost didn't have a self-managed super fund and wanted to create one and have gold a part of their portfolio, is there a large cost in actually getting that done, compared to just leaving it where they are?
I think at the end of the day, most of our savvy investors will look at the overall cost and tax implication as well. So yes, there's always an initial cost to form a self-managed super fund or a trust, and getting the right advice. But in terms of the cost compared to the tax saving, okay, so going back to our chart on the tic-tac-toe, Phil, we can bring that up. You could see that holding in your personal name, the tax could be up to 47%, which is almost half of the capital gain. Whereas if you structure it correctly in a self-managed super fund or a trust, then you could be pocketing more of the gain in your pocket. So it depends a lot about, so if your capital gain is 100,000, for example, and we're talking about long term, okay? Long term, 100,000. So if you compare with personal name, it's 47, could be up to 47,000. I haven't, depending on your situation. In a trust, it could be 0 to 47, and in an SMSF is 0 to 15,000. So 47 minus 15, that's already a saving of nearly, close to 30,000, and that's just a one-off transaction. So when you ask me, is it cost? How much does it cost? Well, I look at the overall strategy. Well, how much does it? What's your opportunity cost if you did not move to SMSF?
Yeah, and that's really important to see in that way. It's not just the monetary value today; it's the long-term strategy. How much has that affected you, and how far you potentially be behind if you don't make a move?
Absolutely, and a lot of people make the start in their personal name and realize when they have, because they're starting out, so they don't realize. But when they want to move to a trust, that's where the capital gains hit them. Because every time you move structure, that's when it triggers the tax event or the tax implication. So I encourage everyone that if you're interested in getting into gold, now is a great time to have a chat with to your financial advisor. But we also have a special offer for our members, because I think that a lot of people will come afterwards and say, how, what's the next step and how I can start to get my personal plan in place, and my investment strategy. So we're offering, all our viewers today to have an initial strategy, a complementary initial strategy to see what are your GPS, goals, planning strategy, and see if we can help you to further that and to implement that. Cool. So that's So,
fantastic. I'll pop that in the chat for people to contact you as well. Fantastic. Is there any more questions out there? Here's your chance. Okay, it's getting near the hour. It's been a wonderful show today. But if you have any questions, we might be please put it in now. Okay. That looks like we're good. So, awesome show today. And how about next week? Next week, Lan, we're moving on from physical gold to what some people call digital gold, cryptocurrencies. So we've got a special guest from the States, Joshua Denny. He's the chairman of the Inevitable Group. He has been in the blockchain space for a while now, and he's actually co-founded the Blockchain Funding Inc. He's been featured on multiple media outlets, including Inc., California Business Journal, Yahoo Finance, USA Today. He's an international speaker, author as well. So he will be here talking about cryptocurrencies and why he believes cryptocurrencies should be a part of everybody's portfolio as well. So I'm really looking forward to that.
Yes. Yeah, and guys, if you have any questions for our special guest, Joshua, next week, please just send them in the chat to myself or Phil, because this guy is an international speaker. He is overseas. So we're very, delighted to have him to share his view. And I will be covering also the tax side on crypto tax, on Bitcoin. If you have some and you haven't done anything about it, I'll also cover in the end about that too, what you can do, what you should do. So we thank you again. Thank you, Phil, for being co-host, and I look forward to seeing everyone again next week. And what time is it next? Is it Tuesday next week?
Tuesday at 12 o'clock.
Okay, thank you.
Okay, so let's call it a show, and we'll look forward to seeing everybody next week. Thank you.
Thanks, everyone. Bye.
Bye.